Most retail investors rely on the same predictable playbook. They read carefully edited annual reports, and they listen to CEOs make big promises on financial television. Because this curated public relations data is broadcast to everyone on Earth simultaneously, it offers no competitive advantage. Without an informational edge, retail investors fall into a herd mentality. They blindly chase stocks hitting 52-week lows, or they settle for the slow growth of stagnant dividend companies. Trading the stock market like a public casino powered by PR numbers guarantees average returns at best and a total loss of capital at worst. In 1929, the Great Depression wiped out a fortune for an investor named Philip A. Fisher. The crash led him to a realization: surface-level financial numbers are often a mirage. He developed a new philosophy focused entirely on aggressive growth, a strategy that eventually became the structural foundation for Warren Buffett's investing career. Fisher determined that capturing multi-baggers, stocks that multiply your money 10 to 40 times over, requires ignoring the public narrative and examining the granular, operational reality of a business. He named his investigative process Scuttlebutt. It treats stock picking like field reporting, cross-referencing information from vendors, customers, and competitors to verify how a company actually functions. Take this revenue chart. For a business to prove its growth engine is working, this distinct section of sales should come from products that didn't exist 3 years ago. That represents genuine research and development. In the mid-20th century, Fisher identified companies pouring cash into complex chemical engineering and new technologies, prioritizing that groundwork over short-term quarterly profits. But back-end engineering only matters if the front line delivers. You test a brand by its customer treatment. Do they honor warranties with no questions asked to build lifelong loyalty, or do they fight their own buyers over small expenses? A company's future value isn't found on last quarter's sales receipt. It lives inside its research pipeline and its reputation with consumers. Even a revolutionary product will fail if the internal corporate culture is toxic. Neglected human resources, high employee turnover, and the threat of labor strikes are invisible forces that quietly bleed profit margins dry. These operational details lead an investigator to the ultimate metric: management integrity. A CEO who spends their time appearing on television to artificially inflate a stock price is a significant red flag. They are managing the valuation instead of running the business. Fisher's rule was absolute. If an investor has any reason to doubt the honesty of the executive team, every other positive metric on the balance sheet is void. Financial data is useless if the human beings providing that data lack competence or integrity. If you successfully ignore the PR, avoid the herd, and identify a high-integrity growth company, the hardest phase of investing has only just begun. Philip Fisher's son, Kenneth, used his father's methodology to identify a promising steel manufacturing stock and bought his shares. After holding the position for 2 or 3 years and making a decent profit, Kenneth lost his patience and sold. Philip Fisher had purchased the exact same stock, but he trusted his research and refused to sell. This timeline graph shows the disparity. That small bump early on is the son's quick profit, but as the timeline extends, the line curves exponentially upwards, representing the 40 times return his father captured by holding for decades. The true test of an investor is the psychological discipline to hold your position and not panic sell when the market faces depressions, labor strikes, or global wars. Uncommon profits require 2 rare skills: the investigative rigor to verify a company's performance and the psychological discipline to sit tight for decades.